Gerard, we've seen this movie so many times. Before the quarter, they come out bank after bank and they warn about trading revenue. How significant is it this time around?
John, you're absolutely right. You know, it's a very volatile number for the large universal banks as well as for Goldman Sachs and Morgan Stanley. And I think what you're going to find is that for the universal banks, it's not as material to their numbers as it is, of course, to Goldman and Morgan Stanley. But we were anticipating, and I think most investors are anticipating, that the second quarter numbers were going to be weak relative to last year. And that's what we've heard this week.
So, Gerard, what are your expectations for Q2? Can they overcome the trading revenue blip in other areas of the bank? And which names are you most confident on?
I think they will, John. When you take a look at the diversified revenue model of J.P. Morgan or Bank of America, and for that matter, Citigroup, these companies are very diversified and they're able to overcome these slowdowns in their capital markets businesses by having very strong consumer and commercial lending businesses. So for investors looking to play a diversified revenue stream, owning Bank of America or J.P. Morgan is the way to go. And then Citi, of course, is a global play, and you see the stock performing very well today on the bet that we're not going to go into a global recession.
Gerard, the other issue that you and I have got to talk about is a conversation we have had so many times. The investor bias and how investor views around financials are shaped by what is happening in the bond market. Walk me through how material or not a move lower in treasury yields is, an inversion of the yield curve for some of the names that fall under your coverage.
John, you're absolutely right. You and I have been talking about this for some time, and a yield curve is very important. Ideally, we'd like to see a steeper curve, and the reason I think you're seeing the banks perform better yesterday and today is that there's a greater expectation that the Fed is going to cut short-term interest rates sometime this year. If the Fed cuts short-term interest rates, it's going to steepen the yield curve, and I ask investors to harken back to 1994-95 and take a look at how the bank stocks did when Greenspan pivoted in February of 1995, started cutting rates by July of 95, the bank stocks had a great year. If the Fed starts to cut short-term rates and steepens that yield curve, bank stocks are going to rally.